Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Welcome to Fun with Annuities, the #1 annuity podcast on the planet. I'm your host, Stan the Annuity Man, America's annuity agent, licensed in all 50 states. The great part about the Fun with Annuities podcast is you can listen to it on all major podcast platforms. You can also look at my facial expressions and the guest as well on the Fun with Annuities YouTube channel. This thing is growing by leaps and bounds, and I think it's because we're not just talking about annuities. I mean, the Fun with Annuities YouTube channel slogan is living the reality, not the dream. So when I bring people on, I want them to be talking about things that might not be annuities, might be markets, might be investments, might be a lot of things. But today's guest is a repeat guest. He actually was the inaugural, celebrity guest on the Fun with Annuities podcast, and he is mad smart, personal friend, went to the University of Chapel Hill, which makes him almost royalty. Because he's a basketball fan. His name is Owen Schrum. Owen, welcome to Fun with Annuities once again.
It is good to be here with you. It's good to be here with the audience. I had a great time last time, and I'm glad to be here.
Now, you can go, as you know, with when Owen was on the last time, he has his own page in perpetuity on theannuityman.com. So you can go to theannuityman.com, go to the podcast drop downs. We'll have all of Owen's information where you can, call him, schedule a call, see if he fits for you. He runs one of the top money management firms in the country, based out of Raleigh, North Carolina, God's country. It's schrumpw.com, schrumpw.com, all together. And so if you want to go there and check him out, but he's been doing this a long, long time. Full disclosure, Owen and I used to be partners at Morgan Stanley long time ago. He taught me everything I know and about the markets, and he's forgotten that more than most people will ever know about the stock market, markets in general, finances, etc. He just knows his stuff. He's one of those guys. It's kind of like a basketball player that has natural ability. He has natural ability to lessen risk of a portfolio while managing it for growth, and that is a skill set that not many people possess. Owen, let's jump right in. There's a crisis in this country, Owen.
Absolutely.
And it's not COVID. It is and it isn't, but it's really not. The crisis is a retirement crisis. Can you jump in and give the listeners what that means to you?
Absolutely. Before COVID dominated the news, a lot of news was generated by a report done by the National Retirement Association. And they called it the crisis in retirement in America. And their study showed, get this, Stan and audience, 68% of all people over 60 are not going to have sufficient money to live on when they retire. 68%. In addition to that, we've got the next generations after that, the Generation X, the millennials, marching towards that same conclusion. In result, there's a real crisis in America, and it can't be solved by Social Security. And we're here to talk about that and how that should not happen to your listening and viewing audience.
Absolutely. Social Security, as we all know, and some of us forget, it was never put on the planet to be the sole income source for retirement, yet it is for most people. And as we know, financially, we can have our arguments about if it's solvent, if they can pay it, etc. I do think down the road, and I'd like to get your comment on this. I'm guessing there's going to be some serious means testing, meaning you evil rich people out there, that's worked your butts off and saved and put money aside and scrimped and done without. You're the evil rich, and they're going to probably punish you. Do you think that will happen with our lovely government?
It's funny you say that. Literally this morning, anyone ever heard of Ken Langone, founder of Home Depot? He's
Love
on
that
CNBC.
Guy. If I still drank beer, that'd be a guy I want to drink beer with. Absolutely.
He was on CNBC with Elizabeth Warren, and the topic was If you make over a certain amount of money, you don't get Social Security. Now, the politicians don't want to take that on. And quite frankly, let's face it, if you need to be means tested, it's not an issue. The issue is that Social Security is not enough for the average person to live on in retirement and meet the standard of living that they have right now.
Correct.
So while that may or may not happen, more importantly is to make sure, in addition to Social Security, that you have enough wealth and income sources so that you're not working at a store greeting people when they walk in the door at 75.
I always tell people, Owen, that if there is a hell, and I go there, I'll be a Walmart greeter and then run a restaurant at night. That'll be my punishment, because that would not be good. Finra, let's talk about Finra for a second. Explain to people who Finra is and just kind of some of the problems and some of the bad investment decisions that Finra is concerned about, you're concerned about. Tie that up in a nice bow.
Well, let's first off say what Finra is. It is Financial Industry Regulatory Association. Much like the bar and the AMA, it is the agency, self-regulatory agency that oversees, regulates the financial services industry. And while it is not a government agency, they are empowered with the same subpoena laws, and they're empowered with the same enforcement laws. So it is the cop of the financial industry, in addition to the SEC, the Securities and Exchange Commission, and we're going to talk about both of those. What's important is, I'm going to back up for a little bit, if I may, Stan.
Please do.
A lot of people say this crisis in America is caused by a lack of savings, and I'm not convinced. It is certainly an important part of it. I also believe strongly, and I'd like your input, that it's caused by people making not the smartest decisions about the money they've earned. They're not making the smartest investment decisions with their money. They're not earning enough money so that it grows, or they're not investing it so that it grows. So it's not just that you're not saving enough, it's that you're not investing your money correctly to have it grow to supplement your wealth. And the reason I bring that up is there's lots of reasons for those poor decisions. And one of them, I call it the free paradigm. And everybody's searching for something free. And as we know, in business and in industry, there is no free lunch. It's an old saying, but boy, is it true.
And if you go to the free lunch, don't buy anything.
Don't eat the chicken.
Especially when it comes to annuities. Eat the food, swallow the food, not the pitch.
So Finra's job is to point these things out to the public and keeping it from happening, and then policing the industry to keep it from happening. They did a study in 2018. Get this number. This is a real number from the agency. $50 billion in claims of investment malfeasance. $50 billion. Wow. 1.2 million claims to Finra against poor investment advice or worse. 9% of those claimants went bankrupt. So it's not just you're not saving enough, it's that you're not investing your money and making best decisions. And one of the things we want to do is talk about why that is the case often. It's because people are being confused or misled or not correctly disclosed that everything isn't free and it's costing them their savings.
Well, and also too, I believe that it can be summed up in one phrase, whether it's annuities, life insurance products, investments, ETFs, stocks, bonds, whatever. If it sounds too good to be true, it is every single time, no exceptions.
Period.
Okay. Period. And if I don't care what anybody is telling you, whether it's annuities or non-annuities, if it just says, wait a minute, that sounds really good, then it's not true. Okay. It's just not. And if for old grizzled veterans like Owen and I, who have cowboy boots older than most financial advisors that's this time, and Owen said something to me a long time ago that's always stuck. And he said, most advisors, and I'll throw in agents, have never seen a down market. They come and go. There's a lot of turnover in the financial services business. But for people like Owen and I, we have scars, okay, where we have been there when markets really did take a dive and there were some issues. we're in a bull market, Owen. People just think it's going to go up. They forgot about 2008, haven't they?
They forgot about 2008. They forgot about 2000,
Yeah.
2001. They forgot about 1987. But Dan, more important, to that point, I'm going to argue we have had since 2009 a resounding recovery off that recession. The markets have done well. The numbers show most people have not participated in it.
Interesting.
It's
Okay.
a handful of investors. Most investors have not fully participated in markets when they do go up. So it's a double whammy. When it goes down, they suffer. When it goes up, they don't build the wealth they should because of not always making the best decisions.
And that's sad. I think it's a lack of education. I think there's a fear factor there as well. I think there's a lot of people that grew up without wealth that all of a sudden find themselves in upper middle class America where they have some wealth. I know for a fact that probably both of us got into this business a long, long time ago because we grew up in families that never participated in markets. And it was, we were trying to figure out, hey, wait a minute, how all these people got all this money? how does this work? So what's for you, how do you take someone that calls you and is, they're like, I really don't want to lose any money, but they need growth. How do you talk to them about why they need to tiptoe in?
Well, first off, let's look at the environment we're in. Inflation's running 2%. I don't know if anybody noticed the last inflation claim came in at 5.2% for the last quarter. And so if you don't invest your money for growth, you're receiving between 0.1 and 1.5% on your money. And then if you're making even some really good investments like fixed annuities, Stan, what are they, 3%?
3% on a 5-year at the time of this taping. Look at the date of this taping in case you're listening to it down the road. But that's just a reflection of current interest rates, et cetera. The reason that annuity companies can provide a little bit more, they have a dynamic pricing model, but it's still a contractual guarantee. But reality is reality. And that's the reason the name of this, the slogan of this podcast is living the reality, not the dream. And what that means is not the sales pitch dream, whether it's annuities or non-annuities. So you tell them what? They're say, well, why do I get in? Why do I get in now? What are you telling people?
Well, half the time, the first 25% of the conversation is unteaching them what other people have already told them because it wasn't true. I'm sorry, it wasn't true. And that's some of the things we're going to talk about. But what you do talk about is you give them numbers, you show them over time what returns are. If you give it a 5-year period, and if you have that long, and then you run the numbers, you do a plan, you allocate, you diversify. You don't have all your eggs in one basket. You have some eggs in stocks. You have some eggs in annuities. You have some in CDs. You have a diversified portfolio that fits your risk level and fits your return so that you will be able to retire successfully. So the word is you have a plan, you work it, you're diversified, and you are allocated correctly.
And I think people get misled when the word active management is thrown around. Active management doesn't mean you're trading all the time. Active management means that Owen and his team, they're watching and they're thinking and they're looking. And they're making decisions, but it's not some Wall Street trader on the floor or whatever you have in your mind that is happening. One thing I want to talk to you about that we were emailing back and forth on some specific topics. Anytime there's a low interest rate environment, we've been around the block a little bit too long. That's when annuity companies and brokerage firms and banks start making up things. And we call them structured products. They make them up out of midair. They put names on them. They do back-tested numbers that look great that aren't real. In the annuity world, the newest thing is what's called a buffered annuity. I call it a copay annuity, meaning that you're going to share in some of the losses, which is why are you even buying an annuity at that point? And you have limited upside. But talk about some of the structured products you've seen people make mistakes with that are currently out there, what to watch for, and what's really happening with these structured brokerage type products.
Well, first, when someone's going to recommend it to you, they're not going to say, Stan, I have a structured product for you. They're going to say, I have this investment that lets you go up when the market goes up, but your principal's protected. First off, light bulb.
Yeah, listen, I always tell people, and that's your typical indexed annuity pitch or buffered annuity pitch. If that was true, then Owen and I get in the rented Mercedes Sprinter van, drive to DC, and convince them the Fed that's all they need to buy. I mean, once again, if it sounds too good to be true, it is every single time. So go further with the structured stuff.
A structured product. The origin is people feel like they're not getting what they want out of their investment. And let me explain for a second. They want growth and they want guarantees. That's what they want. Well, guess what Wall Street insurance companies are very good at doing? Selling people what they think they want. It's true.
Exactly.
So they create structured investments in a single investment. And here's how it's set up. It's a debt instrument. They are loaning, it's a debt obligation. You're loaning them money. Then inside that debt instrument, they're investing in options, commodities, debt structures, and alternative investments, derivatives. And then they wrap it together and say the combination of all those three things that are happening when the models work, we're going to guarantee you're going to get your money back in 3 years. And if the market goes up, it's going to grow, or they'll guarantee you'll get 8%, or they'll guarantee you get 6%. But guess what? The models don't always work. They also typically have 6 to 7% fees inside of them.
Yeah.
And they typically also, they're illiquid. You can't cash them in without great penalties, if at all. And by the way, guess what the firm's doing? The investment firm, the insurance company, is getting free. They're borrowing money. They're getting cheap money, generating fees off of it for themselves and their brokers. And if and when it works, and if it doesn't, they move on. They sell billions of dollars of them. A study by Ohio State Finance Department. In 2018, people lost $52 billion in structured products. A large number. The SEC did a warning people about structured products. But still, they're out there. You're just not going. No one's going to say though it's a structured product.
No, they're going to call it made up words, quarks and mics and rips and what. I mean, they're made up out of midair. I mean, it kills me. I always tell people with annuities, and I think this goes with investments. And I know that you really are a good explainer and simplifier of the process and how things work. But if you cannot explain it to a 9-year-old, don't buy it. No offense to 9-year-olds. And with these structured products, there's no way. I would say 95% of the people selling them can't explain them. They're just doing a 30,000-foot flyover. Here's the key points. What are some of the names of these things that are out there?
Principal protected notes.
Great.
Reverse convertible notes. Guaranteed principal notes. Auction rate securities. Sparks. Direct reverse upside notes.
Stop. There's something called a direct reverse upside note?
There's a list this long.
That's a DRUN. A direct reverse upside note is a DRUN. DRUN. That's the acronym. Would you like to buy a DRUN? No, sir, it's not a drone. It's a DRUN.
The new one is capital guaranteed notes. So I'm going to ask you a capital guaranteed note, and you buy it, and someone sends you a book that's this thick, and you go read it, and it says we're doing reverse put options, naked spreads, derivative futures contracts. So where do you tie in futures, reverse futures contracts, call options, and put spreads, and then sell something that says capital guaranteed notes?
And me and you both know the people running it are 25 years old. I mean, they're literally right out of master's degrees, getting their MBA, and now they're running. It is scary. Once again, my favorite is the DRUN. We have come up with what was that? What was that again?
Direct reverse obligation notes.
Or upside notes. DRUNs. That's fantastic.
And also the thing you're seeing a lot now is people are selling these and I do want to talk about this real quick. Leveraged ETFs are another form of structured products where 3 times up the market, if the market goes down, again, the SEC just issued a warning. People have been destroyed by that. They only work for a day. because the derivative contracts and futures contracts inside break down after a day. So people are buying these and being sold to hedge their portfolios. It doesn't work. It doesn't.
Anything that's leveraged, the word leveraged in it. And I always tell people too, be careful if you're buying like a closed-end fund. Back in the day, you taught me a long time ago to see how much they're leveraged, like a leveraged bond fund or something like a bond fund that's leveraged. Leverage isn't good, and I think that's what's going to eventually unwind crypto, because they're leveraging crypto to buy crypto. Buying a credit card, paying off credit card with a credit card. I'm not saying it's exactly like that, but anytime there's leverage and people are in a raging bull market and they've never seen a down market, one of the worst calls you can get in your life is not that someone was in a car accident. The worst call you could possibly get in your life is called a margin call. And people are getting those. They don't know what to do. Explain that, Owen.
Well, margin calls is you have a portfolio, you then borrow against the money in your portfolio to buy more stocks. So if you have $100,000 and the market goes up, you will multiply your upside. But when it goes down 3 times faster. And then when you have to sell something, your margin, so you have to sell securities to meet margin calls and to generate. If you got a $10,000 margin call, you've got to sell $30,500 worth of stocks to meet that margin call. So your losses are leveraged, and you look up and you have no money. It's one of the rare vehicles when you absolutely can lose everything. Look, if you diversify into a good investment portfolio, you may have some bear market short-term losses. You're not going to lose everything. Margin borrowing, you can lose everything.
Oh, and let's talk about mutual funds. People think that mutual funds have kind of died off and ETFs have taken over. Oh, no, my friend. Mutual funds are still out there. They're still profitable. A lot of them are not tax efficient. Give me and the listeners your take on mutual funds and why just individual stocks or individual investments that someone like you would choose are a better solution than what people think is a turnkey approach with mutual funds.
Well, mutual funds have advantages. They also have disadvantages that many people aren't aware of and don't talk about. Let's talk about one disadvantage, and that when you buy a mutual fund, you're buying someone else's gains that you may not have participated in. So this is a real world, Stan, because you and I know these people. Mm-hmm. Here's what you are if you get a mutual fund, if you're a manager at a mutual fund at a big firm. You walk into your desk each day, boot up your computer, and up pops a list of how much you got to buy and sell that day. Mm-hmm. People are always selling to buy houses. The market's going up. People are selling. So every day you get a list, and you've got to raise $100 million in cash that day. So you got to go into your portfolio and sell $100 million worth of stocks. Let's say you bought Apple 10 years ago for $1 million. This is a mutual fund, and now it's worth $100 million. You've got a $99 million gain. That actually happened with Apple. Mm-hmm. It really did. So when he comes in and he's got a list of money he's got to raise, he sells everything in the portfolio, including Apple. He sells some of it. So he's got a gain. He has to realize that gain. If you bought that mutual fund new, your cost basis, you're inheriting that $1 cost basis. So you may have had a loss on your mutual fund, and at the end of the year, get a tax bill. Every year, they have to declare capital gains and capital losses. And you are sharing in 10 years of other people's gains. You're going to be charged and have to pay taxes on money someone else made that you didn't make. Very, very tax inefficient. What can be more tax inefficient than to have to pay taxes on something you didn't make any money on?
Well, and there's all kinds of this is another thing. People don't know the details of mutual funds. There's B shares and C shares and 12B1 fees and all kinds of hidden stuff inside of it that should be disclosed. The firms will say they are in the big piece of the chunky booklet they send you. But what you're saying is you can circumvent all that if you have a professional, fee-based, fee-only money manager that's looking after you on the same side of the table. I think that I think that's shifting to a point. It's not shifting fast enough, in my opinion. I tell my clients all the time, certainly you don't need really, if you have more than 50% in annuities, we need to check, why and what you're doing, because the annuity industry kind of frowns upon once you go past that. So you need someone to manage your money. But with all of the self-directed IRAs out there, Owen, I'm assuming there's hundreds of billions of dollars. Can you talk about self-directed IRAs? Because most people's assets are there, and kind of, what's going on, what the IRS approves and doesn't approve, how crypto works, all of the little nuances and trapdoors that people need to be aware of if they've decided to self-direct their IRA.
Well, there's two kinds of self-directed IRAs. One self-directed IRA is you open up an account with, pick your firm, Fidelity, Schwab, Merrill, and you work with someone or you work with a discount broker and you're directing the trades. The other type of, and we see it all the time, I have some rental property.
Right.
And I want to buy my rental property and put it in an IRA. So you go out and find a specialized custodian who registers your rental property in a self-directed IRA, and you hold non-liquid assets through a custodian and call it an IRA. It can be real estate, it can be Bitcoin, it can be gold, and you have a custodian. A lot of people will want to buy an IPO or put a business interest in there. The IRS has 50, 60 regulations around what you can and cannot do with a directed IRA, a self-custodial IRA. And the rules are very specific and very strict. And if you blink and get one of them wrong, Stan, the IRS disallows the entire IRA, charges penalties, and all taxes are due on that spot on that second for every penny that you've put in that self-custodian IRA.
There are no mulligans with the IRS.
None.
If you're a golfer, mulligan means you hit one in the lake. You say, well, yeah, I'm just going to put another one back on the tee and hit it again. There's no mulligans. Tell me what's going on with IRAs, self-directed IRAs, and some of the crypto nonsense that's out there. How's the IRS looking at that? I know they haven't figured it out, or have they?
They haven't figured it out, but they are putting the rules in. Now their stance right now is they are drafting rules, not just in the United States, but in coordination with other governments.
Of course.
So that they are going to be able to find, report, and you are going to be due taxes on, and there are some instances, now I'm not a CPA, but there are cases now where, because of the complex nature of cryptocurrencies, even if you haven't liquidated it, you can have tax bills due on it under some of the legislation that's being proposed.
This is going to get interesting because,
Really?
and a good friend of mine that is kind of the head analyst for a group called the Palm Beach Letter, his name's Tika Tiwari. He shot me an email the other day, and he's calling for a $500,000 target on Bitcoin. Now, to Tika's credit, 5-6 years ago, he was telling people to buy, Bitcoin at $100. So he has been kind of right on it, but I think if he's right on that, then wow. But the taxation of it is all the IRS cares about. It's all the government cares about. And eventually this is going to get taxed. And I think what's going to actually drive Bitcoin down is when they figure out how to tax it. Do you agree with me?
Yes, and it will be. With the deficits we're running in the country, they're looking for revenue everywhere. And with the explosion of Bitcoin and the acceptance of Bitcoin at some established institutions, there's no way the IRS is going to leave that tax revenue on the table. Absolutely zero chance.
No, if there was ever a Pavlov's dog, all you people know the Pavlov's dog theory, where they, you train the dog and it salivates. IRS is salivating. Okay? They are dripping from the mouth here on the taxation of crypto across the board. What are there, 5,000 cryptocurrencies right now?
Oh, there's so many now. Stan, if I may go back to the self-custodian direct
yes.
IRS that ties into Bitcoin, and I'm not going to mention any specifics, but if you watch TV, you'll recognize it.
Okay.
A lot of very reputable financial shows, news shows, listen to the commercials, what they're touting. Now, I heard one today on the major news network, and they can You can figure out who it was. Are you tired of stock market volatility? Would you like income producing real estate with guaranteed 10% returns?
I saw that.
With no tenant problems? Contact us to show us how we can put this in your IRA. I went and looked up the name. The person that was sponsoring this was completely covered with complaints, had been charged with the SEC, had been charged with the state of Massachusetts. Nonetheless, there it is, legitimately put on for a self-custodian IRA on a major news show. So the other thing I want to mention about protecting your money, with the exception of Stan the Annuity Man, just because it is on the news, because it's on TV, doesn't necessarily mean it's true or legitimate.
No, it's, and it, once again, if it sounds too good to be true, it is every single time. When you hear 10%, I mean, if you hear 8% or 7%, I mean, the money is risk. The money is at risk when you're looking at those type of yields, and they are, what makes me mad about that, yes, they can buy ads and run ads and do that, but they're targeting stupid people.
They are.
Now, stupid people doesn't mean that they're not educated. Some of the stupidest people in the world are really educated and rich. I mean, Ponzi scheme people go after doctors and lawyers. No offense to doctors and lawyers, but that's documented. That's not me making it up. They go after people that think they're smarter than the next guy because it's easier to convince them that this is really going to happen. And, you know, Ponzi schemes happen, 1 to 5 of them, the FBI finds per week. You just don't hear about them because most Ponzi schemes are in the 1 to 5 million range.
The SEC has said most Ponzi schemes and illegitimate investments are spread by what's called affinity fraud, meaning it's doctors that are all in the same hospital.
Churches.
Members.
Churches.
Charity people. Churches.
Yes. Yep.
Because people start talking, hey, let me tell you about this thing. I'm getting 10%. Well, I want to hear about that. So it spreads through affinity groups. So be careful. That's another area to be careful of.
Yeah. Just because your best friend bought it doesn't mean you need to buy it. I got a call the other day from a person that their Bible study group was talking about investments. I'm like, y'all need to start talking about the Bible. And I was looking for the lightning strike at that point, but you just have to be careful. Talk about taxes. I know that that kind of plays into the self-directed. That's a offshoot of that. You talked to me the other day, and it was really interesting what you were saying.
Taxes, first off, what's the greatest expense in your life, even including your house? For most people, it's taxes.
My daughters.
That's right, weddings, outside of weddings. The taxes are one of the biggest financial liabilities you're going to, but more importantly, they really affect your investment return, particularly as you're trying to compound to create wealth for retirement. So there's income. Under new proposals, that could be taxed as much as 48%, depending on the state you live in. Then there's tax deferred. And tax deferred is people, and my point is, I think there's confusion. People say, well, you don't have to pay any taxes, it's deferred. Well, it grows, and when you pay it, you have to pay it at ordinary income rates on the appreciated amount. So don't confuse long-term capital gains, which is where you, under current rule, you hold it for a year and you either pay 15, 20, or 23% on the gains and you're done with it, versus tax deferred where 100,000 grows to 200, and when you take it out to live on it, you pay ordinary income taxes at 28, 30, 43%. So don't confuse capital gains with tax deferred. Don't confuse ordinary income with tax free. Really, the things that are tax free are going to be municipal bonds. And this isn't investment advice, it's just educational lesson.
Correct.
And getting your money back, return of principal.
Yeah, and municipal bonds, interesting you brought that up, because back in the day when we were at Morgan Stanley, back then the individual investor could actually go buy really good muni bond paper, AAA insured, but boy, the institutions have swiped all that up. Since I'm out of that side of the world, Owen, can people buy good investment bond paper or a muni bond paper?
They can buy safe, high quality municipal bond paper, The problem is the rates are going to be 1, 2, and 2.5%.
Right.
For as long as 20 and 30 years, you're locking in
Ouch.
your money to get 2% tax free.
Ouch.
The issue becomes what we call interest rate risk. If interest rates go up and you try to sell your municipal bond, then you'll have a capital loss, because as interest rates, as we all know, if you can see the seesaw effect of
For the people on podcasts, he's doing kind of a seesaw. He looks like he's flying, but yeah.
You know, I'm not flying.
No, I know that you're gravitationally challenged. I understand that. So
if rates go up, your principal of a fixed income investment goes down.
Right.
And the longer term it is, the longer that seesaw lever is, and the more it goes up and down.
Right.
Other thing I want to bring about municipal bonds, remember we started off the free paradigm. People think they're buying things for free.
Right.
And I bet there's thousands of the people who bought this someone's called up and bought a state of Florida municipal bond. But then they buy it, and the first time they get their statement, they pay $10,000 for it, and it's worth $9,700.
Yep.
Their bonds when you buy a bond in the secondary market, which is how most of them are bought.
Yeah, talk about those markups.
They are typically 1, 2 to 3% markups to buy them.
And who's marking those up?
The dealer that you're buying it from, the trading desk, the bond dealer. So they are marking that bond up 1, 2, sometimes 3% for the house to make money and for the broker to make money. And that's marked up and built into your price. And then when you get ready to sell it, they mark it down. It's like buying retail and wholesale. They might mark it down 1 or 2% more. So you spend $10,000 in a municipal bond. What you actually are buying is a $9,500 bond with a 5% markup. The only way to get around that is to buy a new issue bond, one that isn't in the secondary market. You buy it, it comes out new to the market.
And that's what I was talking about. You had told me a while back that the investment banks and the private equity firms are literally going in and buying the whole allotment. Correct.
A good issue, they come in. They don't even go through the bond rating. They just come in and do their own due diligence and buy the whole issue.
Buy the whole water bond issue, right?
Buy it all.
Is there still what we used to call green mailing, like pumping a stock up and getting ahead of it? If you're one of these people on the, I'm assuming the internet is ripe with stock pumping and front running, green mailing, however you want to. Is that still happening?
You know, I think it's changed. First off, I want to be upfront with you guys. I'm sort of out of that world these days.
You man it. You're a legit high level money manager. So I know you don't get down in the weeds with these idiots, but people do listen to them.
So I think it shifted. It shifted from literally, what was the boiler room guys that they did?
Yeah.
The movie about a bunch of guys in
Blind to Robinson.
They pump the stocks up and turn around and sell them to someone else. I'm sure that goes on, but now the pump and dump stuff is done in internet forums.
Right.
The GameStops.
Yes.
Where you get guys in rooms talking up stocks on the internet forums, and then they go to the Robinhoods and trade for, once again, free.
Sure.
Once again, free, sure. Even though that brokerage firm may be selling that transaction trade to the very person at the hedge fund that's selling it. So
people just need to keep it simple. I know that's what sets you apart from everybody I really know in this space. I know a couple more that have a simplistic approach, but yours is very, very simple. Maybe that comes from the fact that we both played college sports and we had to interact with our teammates and coaches, and you can't be too complex with them. But I do think it carries over, especially, with my stuff is making annuity simple. That's on my website. On your stuff, it's making investment simple. And I don't want to say financial planning because, me and you were talking about that recently. The financial planning word is thrown around incorrectly, and it's misleading when people say I'm a financial planner. I mean, give me a break. Go off on that topic for a second, factually, of course.
Real financial planning is both time consuming thorough and when I say complicated, in depth.
Mm-hmm.
It takes time, it takes effort, it takes talent to do and interpret the results and then implement the results. Unfortunately, financial planning, free financial planning, I hate that, I'm sorry, but financial planning is being, and they're very simplistic versions of little models that you frankly could do on your phone app. And they do a financial plan, and guess what you usually end up needing after doing the financial plan?
Some product, right?
Usually it's a variable annuity.
Ugh. Nothing against my friends in the variable annuity world. I don't, disclaimer, I do not sell variable annuities. I sell all the other fixed principal protected transfer risk products. But no offense to variable annuity guys out there. You can send your angry emails to me like you always do. But variable annuities is a bunch of mutual funds wrapped in a life insurance wrapper with a lifetime fee for the life of the policy. That's great, but you can do that better with either someone who manages your money that you're paying a fee to. And let me get to that point. Once again, going to the free, you don't go to the doctor and expect that doctor, surgeon, whoever, to not charge you. If you're getting legitimate financial advice from a professional with decades of experience, you're going to pay them, and it's going to be worth every penny in most cases. I know that drives you crazy. I know that drives me crazy. But this free stuff that's out there, people need to understand that to get quality, you have to pay for quality.
So a financial plan will take 10 hours to put together.
A real one. Yeah.
Real one. Name anyone that can have a good professional do a 10 hours worth of work for free.
Mm-hmm.
Unless they're committing time to their charity, and these aren't charity events. My point is, if a financial plan is free, it comes with strings. A real financial plan is implemented with investment, with asset allocation, tax planning, estate planning, risk management, and they're all coordinated holistically together. And the plan is the roadmap, but they're usually wrapped together, and they are not and cannot be free.
One other thing I wanted to talk to you about before I go into kind of a more broader approach to the markets is anytime that markets are, raging bull market, but the interest rates are really, really low, and you have 10,000 baby boomers hitting 65 every day looking for guarantees, that's when the Reits and the preferred stock pitches start coming up. Can you explain to people Reits and preferred stock, because they have these high coupons on them, explain why they're high and why it might not be what you think it is?
Okay. Well, first off, let's do the preferred stock for a minute, because Reits I'm going to address separately because it's a tad more complicated.
Okay.
Remember we had the conversation moments ago about a bond's interest rate risk, that is how much it goes up and down when interest rates change, is directly tied to how long-term the bond is. Let me think of it this way. If everybody out here, you bought a 2% bond for 30 years. And 5 years from now, you can go out to the bank and buy one for 5%. Why would anybody want your 2% bond when they can go get 5%? Correct. So your price is reflected to that. A preferred stock is a type of a debt instrument, like a bond, with no maturity, or 40 or 50-year maturity.
Right.
So it can have tremendous interest rate risk, and as such has higher interest rate coupons, but only because you're buying a 50-year obligation, essentially. So that's number one. Reits. The big issue with Reits today, according to the SEC and Finra, are what are these called non-publicly traded, non-registered Reits. Real estate investment trusts, real estate trusts that are not organized companies trading on the markets. They're private, unregistered securities. So if the word private, unregistered gives you pause, it should.
Exactly.
It should. And that, there was, a warning issued by the National Association of Securities Advisors of the coordination with FINRA saying, watch out for abuses. Many of the abuses are happening with non-registered private REITs. I contrast that to publicly traded REITs, which are nothing more than a form of an investment trust that trades like a stock on the New York Stock Exchange or NASDAQ, and they hold real estate. They may hold apartments, they may hold malls, they may hold houses. The new thing is a lot of them hold storage units and hold digital towers, but there are real estate trusts that trade on the market. And those are less, I'll say problematic, less prone to abuses than are these private, non-registered REITs that are popping up everywhere.
But once again, I think we can look at all of this stuff, and annuities included. If that yield number looks way too high, there's an asterisk beside it. It needs to be explained. It sounds too good to be true. It is every single time. You know, I would just encourage you to contact Owen and his team at shrumpw.com, SCHRUMPW.com. Talk to him. You know, get him on the phone. Tell him your situation. He's brutally honest. If I'm the walking middle finger of annuity truth, he's not a walking middle finger. He's nicer than I am, but he's brutally factual. Let's just put it like that. And I think the older you get in this business, the longer you've done it, there's no reason to tiptoe. You know, we're going to tell you if it doesn't make sense. We're going to tell you if you're off base. We're going to tell you if it's right. We're going to tell you if you're putting too much money into something. You know, and I think people understand that they can get that flavor from us as well. Oh, and this COVID thing is kind of akin to World War III. To me, if you look back at World War II, we really haven't printed money like this since World War II. And the markets love low interest rates. I always tell people, you know, the 10-year treasury is low to us, but around the world, it's not low. You know, and I think these are probably normal interest rates going forward, normal levels, and they could go lower. I hope they don't. But at the time of this taping, what's your take on markets here? I know you're always risk averse and you're always looking at that, but we're in blue water, as you always say. What's your take here?
I'm going to quote, Stan, you and I forever have followed a very smart man who won't mind me dropping his Dr.
Jeremy
Siegel at Wharton.
Jeremy Siegel.
His comment is twofold, and this is a broad economic comment from a very noted man that I have a lot of respect for. So take that for what it is. He says, like no time in history since World War II have we had this kind of liquidity hit the market. Counting what the Fed does, counting what the government does, we're looking at $10 trillion. That's why housing prices, a house sells in a day in most neighborhoods in America. I'm getting calls on used cars because the dealers want to buy them back at a profit because used cars have gone up. Everything is going up because there's so much. When I say liquidity, I'm talking about money. Money in people's pockets. There's so much money out there and they're spending it and is chasing up prices of goods. That includes financial instruments. So there's trillions of dollars chasing money, and that's driving up stock prices. That money's not going away. It's there. It's in the market. They're not taking it away. So that's what's supporting the market right now. His greater concern when 12, 24, and 36 months down the road is the short-term effects of all this liquidity creating inflation. You mentioned very few advisors have seen bear markets. Well, the last bear market was 10 years ago. The last inflation was 30. And very few people, fortunately, have seen inflation. It's real, it's destructive, and it is a concern. So that is the Damocles sword hanging over many markets. Is what is the effect? Is the Fed going to be able to walk this balance sheet of raising interest rates to keep inflation in check without hurting the overall stock market? Right now, there's liquidity out there. There's money chasing, and that's being reflected in the markets. How that plays out is going to be very interesting to see.
Well, and also too, how the politicians are going to handle looks like the COVID rearing its ugly head ongoing for the rest of our lives, and how they play that from a fear standpoint and how that affects business. Obviously, coming out of COVID, it was easy to predict that earnings were going to be good just because they were, people were getting back up and running. But I think a lot of people use their stimulus money. We're a consumer economy, so they're using their money to buy things. Mm-hmm. Eventually, that's going to run out. People are going to have to go back to work. Reality is going to have to set in. Will reality set into the markets, in your opinion? Do you think they will stabilize, or will there be some tough times ahead?
I'm going to give you draw upon a historical reference here, because as you can understand, I'm sure your audience can understand, I can't go out here if I don't know everybody's specific situation and make blanket recommendations. I'm going to give you a quick market history lesson, because if you turn on the news, a lot of people will say the Fed's going to raise interest rates, the market's going to go to Hades and handbasket, and that's not usually the case. And it makes sense when you hear the reason. The Fed raises interest rates. Why? Because the markets are overheating. The economy is overheating, rather. When the economy is overheating, what does earnings do? Companies raise prices. So when the economy is overheating, at least for now, earnings of businesses are going up also. And the market is a reflection of dividends and growing earnings. Mm-hmm. So why is the Fed raising interest rates? It's to slow down the economy. But as they raise interest rates, sure, it may sell off at first, but then eventually it continues to go up because the economy is still growing. Then there's a point, they always go too far. There's never been a case in history where they hit it just right. So they raise interest rates and they stall out the economy. Raising interest rates stalls capital investment. People start pulling back in, the economy draws, and then they stop raising interest rates. That's when recessions usually happen, is at that point when they stop raising interest rates. That's when recessions happen. And as we all know, bear markets often follow recessions.
Oh, and tell people about the process at shrumpw.com. Tell them about how you guys differentiate yourself from the noise out there. Why will people feel comfortable with Owen and his team?
Well, first off, we are fiduciaries, strict to the law. We work for clients' best interest by law and sign a fiduciary pledge that we do this. Our business, technically, we call it wealth management. Google wealth management. There's 10,000 people that say wealth managers.
Right.
93% of them, as a study, pay attention only to investments. They do investment consulting. Nothing wrong with that. They're quite good at it. But to us, wealth management means investment consulting, tax minimization, risk management, estate planning, and making sure your wills and your directives are in place. And if you're so charitably inclined, or if you have a business planning. So whereas to us, first and foremost, we're strict fiduciary fee-based advisors, no commissions. We have to work for clients' best interest. We look at your entire financial situation that not just includes investment consulting, but includes lowering your taxes, making sure you pass things on to your heirs safely, and all your assets are protected by working with really smart people like Stan, the annuity man, in the risk management area.
I mean, I would encourage everyone that's listening and viewing this to at least give them a call. We'll have all of his contact information on the site at theannuityman.com. Any last words of wisdom, Mr. Schrum, that's non-basketball or guitar oriented?
I'd like to talk basketball and guitar right now, but I want to hearken back to what you said for your audience. And first and foremost, if it looks too good to be true, it is. It is. Not everybody's forthright out there. And secondly, with the power of investment and the power of compounding, people can have a successful retirement by investing well, saving well, investing well, doing it conservatively, and doing it smart.
And that's beautiful. That is absolutely the truth. Owen, you're not going to, this isn't your last rodeo with us. I mean, we're going to bring you back on, especially if markets get volatile and crazy. And anytime that you feel like you want to give the people your wisdom, I really do appreciate you joining us. And for everyone out there, I appreciate you joining Fun with Annuities, the #1 annuity podcast on the planet. Man, is it growing? It's been a surprise. And I really appreciate every one of you out there that's listening and that's viewing us on the Fun with Annuities YouTube channel. And we will see you next week. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MYGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 annuity owner's manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.